Well, this week from Blevins Franks, we welcome Brett Hanson back to the studio. How are you doing, Brett?
I'm good, thanks, Howard. How are things with you?
I'm very well, thank you very much. Well, last week, Chris McCann shared his predictions on what tax reforms the UK budget on the 26th of November may contain. It's a long sentence for you. Brett and I will follow this up now by exploring how people can lessen the impact of UK tax rises. So, Brett, let's start with the British expatriates who are living here in Spain. Some UK budgets don't affect them much, but others do. Can you briefly summarise the impact of the 2024 budget for them?
Yes, sure, Howard. So, there were certainly some significant announcements made in last year's UK budget, but the ones which are or will impact British expatriates the most relate to UK inheritance tax on pension funds, pension transfers, and the concept of domicile. Now, I'll try to be brief in summarising all three, but it may not be as brief as some listeners would like. So let's deal with UK inheritance tax first. Our listeners, Howard, will probably be aware that historically, UK inheritance tax was charged at 40% on the property, possessions, and money of somebody who has died as a UK domicile, or if not a UK domicile, then on the assets situated in the UK. And in both of those scenarios, someone's pension funds were not included in this calculation. But Rachel Reeves announced in the budget last October that from the 6th of April 2027, pension funds will be taken into account when calculating UK inheritance tax. There's no doubt that this will increase the UK inheritance tax take and will lead to a significant increase in the number of estates rising above the tax-free threshold of £325,000 and being subject to this tax. Continuing with pensions, Howard, for anyone who is thinking of leaving the UK or have already left and were considering transferring their UK pension out of the UK into, say, a qualifying recognised overseas pension scheme, an exclusion to the overseas transfer charge was removed in last year's budget, meaning that if you now transfer your pension to another country other than the country you live in, a 25% overseas transfer charge will apply to the pension fund. And as there are no cure-ups in Spain, this means if you're living in Spain or wanting to move to Spain and transfer your pension out of the UK, the pension fund will have this 25% transfer charge to pay. I appreciate these two announcements in the last year's budget were not good news, but there was some good news which was announced in the budget which related to domicile. And that's that domicile as we know it has come to an end. And this is important for many British expatriates living outside of the UK because UK inheritance tax has always been determined by someone's domicile status rather than their tax residency. And under the previous rules, some would remain liable to UK inheritance tax on their worldwide assets as long as they were domiciled or deemed domiciled in the UK, even if they had been resident of another country for many years. And whilst residency is easy to define and prove, domicile was a completely different matter, as historically it was based on circumstances and intentions. But this all came to an end on the 6th of April of this year, when the domicile regime was replaced by a system based on long-term residency, where someone is not regarded as a UK domicile once they've been resident in another country for 10 years. So for anyone leaving the UK or have already left, they will remain liable for UK inheritance tax on non-UK assets until they've been resident in another country for up to 10 years. For most UK nationals retiring abroad, however, they'll need to do the full 10 years of residency somewhere else other than in the UK in order to become, in effect, a non-UK domicile. And the great thing is that for those who are considering or are in the process of moving back to the UK, if you've been out of the UK for 10 years, then you can go back to live in the UK for up to 10 years and still remain, in effect, a non-UK domicile for UK inheritance tax purposes, i.e. your assets which are structured correctly and outside of the UK will not be liable to UK inheritance tax.
Taking this and any new tax reforms to be announced into account, what is your advice for our British listeners in Spain? To what extent can they protect their wealth, and how should they go about it?
Well, for any listeners living in Spain and are wanting to avoid UK inheritance tax on their estates, getting their assets outside of the UK would be something to seriously consider, especially if they are close to or have already spent 10 years out of the UK. But before anyone does this, I do recommend that if they are looking to protect their wealth from both UK and Spanish taxes, then they should first speak to a qualified regulated advisor who is authorised to advise them in Spain, but also specialise in both UK and cross-border taxes, as selling or transferring assets from one jurisdiction to another will most likely lead to tax implications which need to be examined. And so, in addition to taking into account the tax rules in the UK, if someone is living in Spain, then the tax rules in Spain will need to be considered too. Likewise, if any listeners are living in the UK and are thinking of moving to Spain, then they should speak to an advisory firm who is regulated to provide advice in the UK, but also understand the tax rules in Spain and have the resources to provide the ongoing advice needed once they've moved here. For these listeners, I would recommend that they speak to an advisory firm who has the skills and knowledge to prepare and implement a strategic plan which will outline a step-by-step strategy which will take them through the whole journey with their move from the UK to Spain, i.e. what assets to sell, when they should be sold, when should the tax-efficient solutions for Spain be set up in order to achieve their objectives.
These days we have many people listening online in the UK. If they're thinking about leaving the UK to live abroad, is Spain a good option for them in terms of tax residence? And can people improve their tax position by moving from the UK to Spain?
Tax residency terms, Howard, Spain can be a fantastic place to live, but this will largely depend upon the type of assets someone has and where they are located, and where someone's income derives from. If you're happy to restructure your assets into tax-efficient solutions for Spain without necessarily bringing your money into Spain, then, as many of our clients can attest to, it is possible to live in Spain without having to pay large amounts of tax. In fact, many of my clients pay significantly less tax here than what they would do if they were resident in the UK. At the same time, with the changes in the UK inheritance tax rules, there are also opportunities to minimise UK inheritance tax and Spanish succession taxes for your loved ones, whilst also minimising the complications and hassle associated with probate.
Talk us through what people in this situation need to do. How early should they start planning for Spanish taxation? When should they adjust their financial planning and buy and sell assets for the best results? Is there anything else they need to know about before leaving the UK?
They're all very good questions, Howard, and what I would say is that at Blevins Franks, our cross-border specialists help provide our advisors with integrated pension, tax and estate planning advice to establish the most suitable solutions for our clients based on their situation and objectives. And what we tend to do is establish their personal situation and objectives, analyse all the available options based on their situation and objectives in order to understand how they can meet their goals, determine their tax implications if they held their assets as they are, and what would be the taxes if in that situation, and what if they restructured, then weigh up the pros and cons, and outline the necessary steps, including when they should sell their assets in order to minimise any taxes in the UK and Spain. Of course, if the client then chooses to proceed with our advice, we can then set up the new arrangements and provide ongoing regulated advice and reviews whilst they're in Spain. So in order to do all that, I would say that ideally, listeners who are looking to move to Spain give us a year to 18 months before they are moving in order for us to ensure that we provide the best advice and are able to cover all of the available options whilst giving them time to reflect on our advice and take action if needed. However, we do come across British expatriates who are only contacting us a month or two before they're leaving, and whilst this doesn't give us a huge amount of time, we can still normally prevent them from making some common but costly errors.
And I guess the website is the first port of call.
Yeah, I would say that if anyone's interested in what we've discussed today, or looking to move to Spain or already living in Spain, then it's worth checking out our website and finding out where their local Blevins Franks office is situated. And via that website, they can contact us.
Many thanks, Brett. We'll talk again next week.
Thanks, Howard. See you next week.